Let's go.
Okay.
Good afternoon. I mean, good evening.
Okay, super. So you can see that well, I'm hoping.
Yep.
Anyway, by way of background, I have an MBA degree with an emphasis in finance. I spent 44 years in corporate finance. It really didn't do anything in personal finance whatsoever. And then in 2007, I retired and went into the personal finance work. I got together with a group of certified financial planners, CFPs. And for the past 16 years, I've been serving clients on a pro bono basis and trying to figure out some of these issues like investing in my advanced age. And over that period of 16 years, I've served about 374 clients so far, and I have 53 that I follow on a monthly basis working part-time. I also have some experience in investing on my own, about 40 years of investing in 401ks, IRAs, mostly that sort of thing. And during that period of time, I was always investing in equities in stocks, and a couple of times went into bonds, but not very much, and found the returns were pretty good. And so I just stuck with them. And then when I got to retirement age, the experts in the field kept saying, well, as you get older, your horizon for investing is shorter. You can't really sustain things through ups and downs, and you ought to move out of equities and move into fixed income securities, bonds and cash and so forth. And I looked at the returns of stocks versus bonds and other options for investing, and I didn't like the comparisons because it kept coming up with this, a very large differential. And so I said, well, I think I'll just stick with the stocks. And I had a very simple formula at that time, and this was as I was retiring. I said, well, I think the stock market has returned about 10% a year on average over the last 93 years or whatever. And I know I have some expenses, so maybe I'll get 9%. And inflation is like 3%. And so if I take my investments, withdraw 6%, I can keep up with inflation. And, this will just work out great. Well, the CFPs laughed at me and said, well, okay, that's a nice little formula, but the stock market doesn't return 10% a year every year. In fact, it very seldom returns 10%. It may return 40%. It may return minus 30%. It goes up and down like crazy, okay? And so how do you know that if you're starting to withdraw a certain amount in your retirement years, how do you know that that's sustainable? Can you really recover from a serious downturn in the market? And so that sent me on a quest that's been about 15 years in the making now. And what I want to share with you this evening is just the numbers of what that looks like, and asking the question, can you withdraw? How much can you withdraw and still get through all the ups and downs of the stock market? And I've got the nice thing about working with the CFPs for 8 years, 8 of the 16 years I was in their offices. They have a lot of data. I've got a book that I get out each year. It's 80 pages long. It has data that's just unbelievable. And so I have a lot of resources at my disposal, and you'll see some of that tonight. But that's kind of the impetus to saying, okay, we have people saying, as you get older, you have to get out of equities and stocks into bonds, fixed assets, because it's just too risky for you. And we're going to talk about risk and so forth. So that's the impetus for it, and that's why we have this presentation tonight. Now, before I go any further, I want to, well, I can't get it to move. There you go. Yeah. So there is a program that's already been recorded with the library called Exposing the Myths of Retirement Investing, and it goes into much greater detail than we'll go into tonight, because I want to get to that final chart and answer those questions. But I recommend you view this. It's several hours long, but it really, I think, condenses all the myths and all the problems that were given with this retirement investing question. And I think it's worth your while going through. We'll take some of the slides from that here and review them quickly, and then get in the nuts and bolts of the analysis. So this is a slide that is in that presentation, and many of you have seen something like this in the past. This is the monthly growth of wealth between 1926 and 2019, and I haven't been able to find one later than that, but it makes the point in any event. What it says is, if in 1926 you had $1 to invest, just to make it easy, what would happen over time? Well, we all know about the Great Depression. And so if you had stocks, small cap or large cap stocks, that's the blue and the gray line, between 26 and 29, things went crazy. It was the roaring 20s, right? And then in 29, the stock market crashed. The small caps almost went to zero, not quite. Large caps were down, but not really that much. So it was very, very volatile. And this was a very tough period of time, the Great Depression, issued in the Great Depression. Some people think, people just lost all their money here. Well, they didn't. No, they lost a lot, but it came back if you didn't sell. And that's one of the things we want to talk about this evening. And then as you go forward, the divergence in these lines is remarkable. Just in terms of perspective, if you had $1 and it inflated over that many years, you'd have $14. You'd have to have $14 to buy the same thing you had to pay for $1. So in 2019, it took $14 to pay for something that cost $1 in 1926. That's 3% plus inflation. If you had treasury bills, you would have $22. If you had government long-term bonds, this is about the riskiest investment you can get in terms of government securities, your dollar would go to $175. Well, sounds okay, that's fine. If you had large cap stocks in an index, bought a lot of them, the dollar went to 9,237. Are you kidding me? 175 versus 9,000 in small caps, which are really wild, 25,000. Most worldwide portfolios have mostly large caps. I mean, that's most of the market. So let's call it 10 grand. So I'm going from $1 to 10 grand. If I mix some of these things in it, I'm diving down toward once you say, well, that's why I kept invested in stocks, because you get an amazing return. And that's the miracle of compound interest. Einstein called it the eighth wonder of the world. The problem, of course, it is very volatile. If you look at the scale, this is not arithmetic, it's logarithmic. And so this downturn right here in 2008 was about 45%. If you look at the scale, that's what it says. It goes from $1,000 to $10,000 in a very short period of time. So they have to go to a logarithmic scale to just show it on a piece of paper. But these are not small dips that you see here, and we'll talk some more about that. But the overall message is stocks outperform bonds over the long term at a tremendous difference. And if you get out of here and go here, you're going to start to make some sacrifices pretty quickly. This is a very interesting chart, and it illustrates a couple of points. It's very busy, but the blue areas are when the stock market is increasing. These are called bull markets, and the prices are going up and up and up and up and up. The orange or gold are the times when it's going down. And we had one of those in 2022, as you recall, went down about 20%. Well, even in the Great Depression, it was only 2.8 years, but it went down like 83% and then came back later, okay? But usually these things don't last very long, 3 months, 2.7 years, 1.3 years, and so on and so forth. But they can be very severe, and that's what scares people. But 3 out of 4 years, 3/4 of the time, you're going to see the stock market improving and paying dividends and all that sort of thing. 1 out of 4 years, you see a decline. So those are bull markets, it's going up, bear markets going down. So that's just typically what happens. Now let's talk about returns. And this talks about the volatility. This chart shows data from 1950 to 2022, 72 years of data. And if you look at rolling averages of 1 year, and you have all stocks, that's the green is all stocks. The highest year would be 47, the lowest year would be minus 39. That's 2008, 2009. If you had a mix of stocks and bonds, you'd see something like this. If you had all bonds, you would see a mix like this. Now, the lesson here is in any 1 year, if you are investing in stocks, it could be very volatile. If you go to bonds, it cuts it way down. And even a 50-50 portfolio reduces this rate. That's 1 year. However, if you look at 5-year rolling averages, in a 5-year period, you seldom lose money in stocks or bonds, and the mixed portfolio is actually positive. And then when you get out to 10 and 20, which is really what we're talking about in terms of a duration of your investments, very little chance you'll lose money. And here again, you see some pretty significant advantages to being in stocks. Here's the chart I'd like to illustrate, and the numbers are really striking. This is taking, for that 72 years, any 20-year period in there. Stocks, the average return was 11.1%, so that if you took $100,000, 20 years later, it would be worth $800,000, 8 times. Okay, if you were in bonds, the average rate was 5.5%, and you would have gotten $292,000 out of your 100 in 20 years. If it's a 50-50 portfolio, and this is something that people start to look at in their 60s, the total return was 8.7, and you would have ended up after 20 years with $527,000. My point is the difference between the 818 and the 527 is a mere $291,000 in 20 years, and that's on $100,000. So if you're retiring with $500,000 or $1 million or whatever, you can multiply those things by that same factor. The difference is tremendous, and so I'm saying, well, you know, give me the 818 versus the 527. That's 291,000. This may make me feel better because it's not as volatile, right? But I'm going to tell my heirs that they just lost 291,000. That's going to be a very unpleasant conversation. The next slide just shows the differential as you move up. So these, again, fixed, if you're all in fixed securities, bonds, and so forth, volatility from 1 year to the next is very low. This is the worst 1 year return, best and worst 1 year returns, 11% minus 0.16. And if you go up, you get much more volatile, as we've seen before. What I want you to look at is the gold dots. That is the average return for 1 year with all bonds. And this is the number, 3.73. If you put in 20% stocks, it goes to 5.26, 40, 60, 6.84, 60% stocks, 8.46, 80% stocks, 10. And in this case, equity would have been 100% equity, but 11.5. So as you drop down into less volatile areas, you lose about 1.5% or 2% a year. And when you compound that over 20 years or more, the numbers are just, the numbers are staggering. It's hundreds of thousands of dollars, even on a modest investment of $100,000. So you really, really pay a price. And so I did want to spend a little bit of time talking about risk, because people look at this kind of volatility, going up and down here in 1 year and even in 5 years, and they say, well, that's risky. Well, volatility is not the same as risk. And if you listen to the pundits, you would think it is. It's very different. So I thought it would be good to take some time just to talk about what is risk. And in the stock market, there are three kinds of risk. And I've defined these as a business risk. That is the chance a business fails and you lose your money. So when I was growing up in Ohio as a lad, we were on a main route to a small town that had 3 traffic lights. And in the fall, we'd always look at the new cars coming through that were being transported to the south from Detroit. And it was kind of fun. And we looked at the new tail fins in the 50s. Okay. And somebody would have told me then that General Motors was not a good investment. I would have said, well, you're crazy. General Motors owns the car market. Yet I lived long enough to see General Motors basically fail and need a government bailout. So any business can fail. If that's all you own is a business, and it can fail and you lose all your money. Now, the antidote to that, of course, is to diversify through mutual funds, own lots of companies. My current investments have 3 mutual funds. Collectively, they own 10,500 companies approximately. So if any one of those companies fails, I don't really care. So that's how you lay off the business risk. You don't invest in any business, you invest in a whole lot of businesses. The second is systemic market risk, and that's the chance the entire market takes a hit. As I'll say later, I retired in 2007, started taking money out of the market in 2008, and we had the worst downturn in my lifetime. So nothing you could do. The entire market went south. You just have to be able to sit there and wait it out. And of course, the antidote to that, and we'll talk about that in our withdrawal weight, is to limit the number of shares sold. I can't control the price of my shares. The market will determine that. But I can control the number of shares I sell. And if I panic out and sell a bunch of shares when the market goes down, shame on me, I'm going to lose a lot of money. And then third is the one I worry about most in my retirement years, and that's inflation risk. And safe investments, as you'll see later, are eroded by inflation. So if I'm getting 5% on government securities and inflation is 8%, well, what do you think? I'm losing money. And the antidote there, of course, is you got to invest in stock mutual funds. You have to have stocks in that mix to beat inflation. So business risk, you diversify. Systemic risk, you limit the number of shares you sell. And inflation risk, you invest in stocks rather than bonds. This is my favorite chart of all time. And this tells you in one picture why, if the market returns 10+% per year in stocks, why do people get half of that? And that's about what happens. It's a little busy. Let me explain it. The left-hand chart shows the flows of money into the stock market or out of the stock market. And these are tens of billions per quarter every 3 months. And so along this line, when you see a bar going up, you're seeing money flow into the stock market, okay? And understand there will always be money flowing in because people who are working now largely are into a 403B or 401k program or IRAs. They're putting money in the market. A lot of that money is going into stocks. Okay, so there's a huge amount of money going in. Normally, you would see a bar going upward. When you see a bar going downward, you have people selling stocks at such a rate that it absolutely offsets these tremendous inflows and creates a negative situation. So there's a huge amount of money flowing out of the stock market at this point in time. And you see various periods of time where that happens and then it gets back here. The line graph, which is the one on the right, that's the S&P 500 index. And so you can see where it goes up and down and down and up and so forth, compared with where the money goes. Well, what's the story here? From 2002 to 2007, the market is in a long bull market. It's going up and up and up and up. And everybody is saying, oh my gosh, people are making tons of money in the market. I need to get in. And the numbers up here are tremendous. Tremendous inflow of money into the stock market. 2008, 2009, it tanks. And what happens is, and these numbers really don't show that this is the net outflow. We're taking all that 401k and 403b money, IRA money, and we're more than offsetting that by cash outflows. So this is people selling in a panic stocks. And that goes on and on and on, even and until the market gets back to greater than it was in 2007 peak, they keep selling. So not only do they sell in the panic, but they keep selling as the market increases. And then one day they wake up and say, oh my gosh, I sold during this period, and now it's back up to where it was before. I've lost, people really made a money, and then they get back in. And so what they're doing, they're selling high, and they're buying high, and they're selling low. So you buy high and you sell low, you have a hard time making money. And this happens every time. And so the lesson here is there are reasons why most investors don't get market returns. Greed drives the market to unsustainable heights, and the people say, stocks are making others rich, I need my share. Fear drives the market to unrealistic lows, people panic and sell out. I'm losing my shirt and I sell to avoid losing my skin. So that's what's happening here. The market's going well, everybody wants in. The market doesn't go well, everybody wants out, and they stay out until the market comes back again, and then money roars into it. It's the same thing all the time. So it's the volatility of the market working against you. And as Warren Buffett has famously said, the market is a wonderful tool to take money from people who are impatient and give it to people who are patient. So another quote from him, what kind of an investor should 95% of the people in the country, and I put myself in that category, they ought to be an indexer. And what that means is you buy and hold low cost, diversified index mutual funds. And if you look at the myths presentation, we unpack that in great detail and tell you exactly what that is. So that's worth looking for. Now, what we're concentrating on tonight is the withdrawal rate, and this is the precursor. You should have, hopefully working with a certified financial planner, a financial plan that should target a percentage annual withdrawal rate. So we're setting up a plan. Now I'm thinking about retiring. I may be retired 30 years. I've already been retired 16 plus years. Never thought it would happen. But it's, most retirement now are long. We're living long. So you should have a plan that says I can afford to withdraw a certain rate every year, year after year, and still prosper. And then the discipline is selling only enough shares to provide the dollars needed in that financial plan. So if that's 5% or 4% or 6%, that's the number of shares you sell just to create that amount of money. You do not sell when the market goes down. You'll sell for any other reason and to collect the dollars you need. And there's an absolute commitment not to sell for any of the reasons. So that's a discipline, and your financial advisor should be your coach and your accountability partner to make sure that you don't panic and sell out. And just a point about using a CFP, they are an effective antidote to fear and greed. They can talk you and prepare you for those things. I remember when I was exercising in my basement in 2009 and the market was tanking, and I looked up at my investment portfolio, and I was at about 55% of what I had when I retired. I said, this is not working out very well. And I'll show you those numbers. But I talked to them and say, what are we going to do? Well, nothing. We're going to keep hold of the plan. And I was going to do that anyway. And so, 18 months later, it's all back. What many people don't understand is a financial planner does a lot of other things other than investments. I mean, there's a whole raft of things that impact your whole financial life. And the going rate is about 1% per year of your investment balance. So if you have $500,000 invested, it's going to cost you $5,000 a year to have them do all the things they do. And I think it's well worth it, worth 10 times that much. If you have over $1 million, it's negotiable probably in terms of the rate. But I recommend that, and they do earn their keep. And in summary, investing at any point in time, whatever your age, low cost, diversified index mutual funds. Again, the myths presentation gives you the detail. Mitigate all investment risk, business risk by diversifying systemic risk by the disciplined withdrawal rate, and inflation risk by investing in stocks, not fixed securities. Engage a CFP to help manage greed and fear. develop a financial plan with a disciplined withdrawal rate, and then hold your CFP accountable, trust and verify. So with that, my background, I want to launch into the work that I've done. And again, when I sat there 18 months into my retirement with 55% of the money I thought I had to start with, I really wanted to look at how much could I withdraw. And again, my simple formula was I'm going to earn 9% on average. I want to maintain my enough capital so that my standard of living doesn't go down. So I want to take out 3% for inflation. So I said, if I could take out 6% a year, if I make 9% after investing expenses and account for inflation, then I should be able to take out 6% a year, and my balance would continue to grow, and I would be fat, dumb, and happy for the rest of my life and pass on, all my fortune to my heirs. So that was the plan. And then the CFP said, well, what about, these vagaries in the market and these ups and downs that I've showed you? What are you going to do about that? Well, I said, okay. Uh-oh. Now what did I do? I'm going to stop sharing and come back in because I've got this now. Okay. So you can see that, Alina? Okay.
Yeah.
So I dug into the data, and I was showing Alina before we started. The CFP firm that I work with had just tons and tons of data. I love data. I mean, here's a 80-page book that just, you see the numbers on there. It's crazy. But I spent years looking at this kind of stuff, and I come up with this Excel worksheet, and we can distribute this to you if you like. But what my premise was to say, okay, I want to go back through my lifetime, and I want to look at what actually happened in the stock market. And I want to pick out the absolute worst periods of time. And I want to say, if I took out my 6% a year and I lived during that period of time, would that have made sense? Would I have survived? Okay, or would I not have been able to get through the down periods? So I was trying to test this thing in the worst possible environments using real data, and it's available. And then my second question is, well, I'm being advised to be more conservative, move into bonds. Would I have been better off going into more conservative investments, buying some bonds rather than stocks, going into all government securities or whatever? Would I be better off doing that? So there's really two questions. Will I survive with this withdrawal rate? And what really does make sense? Could I get through the ups and downs? I want to take actual data. I don't want to be, what ifs. I want to look at what actually happened in the stock market, and I have this data available to me. And so what I did was I identified the worst case scenarios, and that's what you're seeing here. Let me explain the chart a little bit. I started with a beginning balance of $1 million because it's an easy number to check, the math. So my withdrawal rate of 6% was, of course, $60,000 a year. So that's pretty easy math. And these are the drivers. When you get the worksheet, if you want to play with it, you can change that to 5%. Every number on the chart changes immediately, and you see what the effect is. But I had started with 6%. That was my target. And I said, okay, I'm going to take the worst case scenario. And the worst case I could find was if you retired and started withdrawing funds in the year 2000, because this is the annual rate of return of the entire stock market. It's an index that measures worldwide stocks. So the rate of return of the stock market, that's a good measure of it, was minus 1.7, minus 5.2, and minus 13.5, 3 years in a row. Terrible. And so what I did was okay, I'll take the earnings, which is the return times my $1 million. And of course, that's minus $17,000. The inflation rate was 3.4%. So I had to withdraw not $60,000, but $61,020 to take half a year's inflation. and my ending balance was $921. So after the first year, I've lost money. Okay, I've taken money out. Okay, and my ending balance is down. Had I gone to the 40-60 plan, and you can see I've got all these in here. If I can get to them. Oh, here's. Yeah, so I took the 100% stock, and then I said that same ratio, and I'm going to put in 20% bonds. And what kind of rate of return do I get there? And so the ending balance after a year would have been greater, because that's less volatile. Instead of minus 1.7, it's plus 0.4. And if you take this over the other end, get to it. I go all fixed, would have been quite a bit more. And I put in long-term government bonds here at the end, and it would have been even greater. So the first year I kind of looked like a fool. I'm going to stop here at this 40-60 because that's what a lot of people, 60. There was an old formula of 100. You take the number 100 and subtract your age, and that's the difference is what you ought to be in the stock market, and that would be that answer. Okay, so then the second year, I start with 921. I lose another 5.2%. That's minus 47,000. I take out 62,000, and I end up with 811. So you see how that works. After the third year, it's disaster. I've got 638 out of a million. I would have 800 here, but then it comes back. Okay, and so I'm bumping along. Here's 2022. And I've got, of the $1 million, $611,000 left. That's better, actually, than the 40-60. Okay, so the answer is I'm still surviving. I'm not prospering, but I've got money. And here's the kicker: after 23 years, okay, 2000 to 2022, I've started with $1 million. I've withdrawn. Add up all those numbers, 1,000,009, and I got 600 left. So the answer is, can I survive a 6% rate, even in the worst case in my lifetime, to retire if I retired in 2000? The answer is yes. Will I have been better than a 40-60? Yes, twice as good. So the answer to those two questions are yes, even in the worst case, I would have survived. And in fact, going to a 40-60 would have given me less return. Now, some years it would have been higher, but in the long run, it's less. So I'm comforted by that. Then I look at the second worst case scenario. This is the one that's near and dear to my heart, because this is when I did actually retire. 2007, started taking money out. 2008, minus 39 in 1 year. So I lost 398,000. I took out 60,300. Okay, because of inflation. My ending balance is 600. I look like an idiot. 40-60 would have been 775. But again, it comes roaring back. After 15 years, I'm now over $1 million, and I've taken $1.1 million out in just 15 years. Compared to that, my 40-60 is 795. Okay, so even in the second worst case scenario, I'm a couple hundred grand better off than going to 40-60. Third worst case scenario was 1973. Where you just had, instead of starting at 72, 73, you went down 2 years in a row. Again, you look kind of bad the first year, but it does come back. And after 15 years, you've got 2.9 million as opposed to 1.4 million. So you've doubled your return. I mean, that's a lot of money. Just going to 40-60, I've lost $1.5 million. That's in the third worst case scenario. In the meantime, I've taken out $1.6 million and have $2 million. Now, if you look at a good case, well, 1975, you get really good returns right off the bat, and the numbers get ridiculous. So after only 16 years, I've got started with $1 million, I've taken $1.7 million out. I've got 14 million versus 4 from 40-60. And he goes on and on and on. So at this point, I think I'll I'll stop. You have questions, thoughts? We can play with this thing. I'll give it to you. You can play with it. One of the things I've done is to say, okay, my target was 6%. What if I took out 7? What would that look like? Well, at 7%, I've got a 20-year horizon and I'm broke. But doesn't matter. I would be broke with 40-60 also, basically. So, 7% is kind of on the edge in the worst case scenario. Second worst case scenario, then okay. Again, better than the 40-60. Third worst case, third worst case is pretty good. So 7% works. Let's try 8. And there again, third worst scenario, 17 years, and I'm running out of money. Again, better than I would be with 40-60. So, you can push this thing as far as you want. The worst case scenario, I would have run out of money after 16 years, but taking 2.45 million out in the meantime. So it's amazing. I've run as far as going to, I went back to the Depression years. And the only thing I've got is the S&P 500. I don't have this index. It was grim at 6%. Your ending balance, you would have lasted 13 years in the Great Depression. So there are times where, you couldn't take the 6%, but every other time, it's just amazing what the difference is. So, questions, thoughts?
Remind us, please, what 40-60 and 20-80 stand for?
Pardon me? It was 80-20 you want?
What is 20-80 and 40-60?
Well, so 40-60 is 40% stocks, 60% bonds. Okay. And then 80-20 would be 80% stocks, 20% bonds. And then if you go all the way over, and this is short-term bonds, you go all over the end, I've got all fixed, all short-term versus all long-term bonds. And in some cases, like in this worst case scenario at 6%, you would be better off in long-term bonds slightly than in all stocks. That's the only case I could find, really. Second worst case would be $1 million versus 500,000 for long-term bonds. Third worst case, you're out of money in bonds after 14 years. Got 2.9 million. And that's the third worst case. And this is real data. I mean, this is not stuff that's made up. I put in the actual returns every year, the actual inflation rate, withdrawn, inflated, going from 60,000 to this case, 200,000, it's just numbers. But in every case, it's just an amazing difference between, let's look at 80-20. If you look at 80-20, worst case, it's slightly better. Second worst case, it's less. Third worst case, it's less. Really good case, it's a lot less. That's the fourth worst scenario, it's less. I mean, it's just, there's no advantage. Again, if you look at my instance, I'm sitting there in 2009 looking at, that kind of a number and saying, wow, this isn't working out well. And it took a while to get back, and it dipped again in 2018. But, in 2022, you had a 13.8% reduction. That wasn't pretty, but we've come back this year. That's an estimate I put together a few months ago. I don't know whether that'll be right or not, but that's again, there are several conclusions. One, even in the worst times, 100% stocks and a 6% withdrawal rate is okay through 24 years at least. I don't think I worry about more than that. And in every case, 100% beats a 40-60, and most of the time it's by a ridiculous amount. And then, of course, the cautionary note is this is mathematics. And as you saw in those charts earlier, if you are an impatient investor, and if you get panic and bail out when the stock market tanks, all this stuff is for naught, and you will suffer. But if you're patient and just see it through and are very disciplined and stick to, this amount of withdrawal every year and nothing more, this will work. And it works in the absolute worst cases.
So how does it take, oh, sorry.
Go ahead.
How does it take into consideration the inflation?
Right. So that's what I want. The inflation rate, I pump in each year and I withdraw the inflated amount every year. Okay. So I'm starting with 921. I'm taking out 47,000. I'm inflating this amount by 1.6%, and that's what I end up with. Okay. So if you start with the 60,000, it just keeps going up and up and up. So you're taking more and more and more out to live on. Okay. And you're saying, well, I know I'm going to need $100,000 a year 24 years later rather than 60. Okay. And that's factored in. So these numbers are after you have an inflated amount coming out, because I want to keep my standard of living, and I've got to offset that inflation rate each time. But it's, this number plus or minus this number and minus that number gets you that number. And I've used actual rates. That's the beauty of it. I might say, well, what if inflation is this or that? Well, this is what inflation has been. And some of these years, if you go back here, I remember these: 73, 8.7, 74, 12.3, 79 was 13.3, 80 was 12.5. And now you're into really big numbers here. But good years, and you end up with some tremendous returns.
So I have a question. I know that in the recent past, there's been a lot of popular platforms that a lot of individual people to use, such as Acorn, Webull, got the other one. But my question is, how would you recommend about going about those? I know that you first mentioned about having a certified financier planner with you.
Right.
And of course, there's all the options of like having your own brokerage accounts. And how do you err on the side of caution for that?
Right. So again, I would urge you to look at the myths presentation, because it's looking at retirement years and investing in retirement years, but actually the principles apply everywhere. Warren Buffett is famously quoted, and I've heard him many times and seen it in print, that 95 to 98% of the investors, and that's really all of us, it's not Warren, it's all of us, should, with our investments, be invested in diversified, low-cost index mutual funds. And diversified to me means 10,000. I want to have at least 10,000 companies that I'm invested in. And I want to use index or market-based funds where people aren't trying to time the market or pick stocks. I just buy the market. And I think whether you're 20 years old or 80 years old, that's investing. The rest of the stuff is gambling. And if you listen carefully to the business news, they even use the terms of placing bets on this. And there are a million gimmicks in investing, and they all have one thing in common. They all require that you predict the future. And predicting the future of the stock market is absolute folly. And but they put it on the TV every day. You know, one of the questions I ask people going through the myths seminar is to say, well, just watch the business news for a couple of days and take a look at how much of that time is spent on predictions for the future. And the stock market is absolutely brutal. Every time I try to predict the market, I mean, okay, war breaks out in the Middle East and the stock market has a rally in November. Now tell me that makes sense, okay? I mean, I would have said, wait a minute, you can't, and that's what Warren Buffett is saying. You cannot predict what's happening in the market. So just get into index funds, buy the entire market. I say it's 10,000 or more stocks that my CFP recommends, and just ride it out. I'll tell you what, you're younger than I am, I think, probably 60 years. And the 401k, 403b plans are absolutely, I mean, I don't say the only thing. It is a very good thing that the federal government has given us, okay? And one of the wonderful gifts. And the reason is that if you get into an all-stock portfolio that has low cost, like in index funds, when you first start working, 95% of the people just go on holiday. They've set it up, the money goes in, they don't even look at the reports, they just go to work. They don't even think about it. And that's a godsend because you don't do anything. To take the money out, number one, has severe penalties, and nobody does anything to change it. It goes on autopilot. And that's the perfect solution. That's assuming you invest in the right thing to start with. You just keep putting money in every month, every quarter, whatever, and letting it ride. And you wake up 30 years later, and it's unbelievable. I mean, I worked medical field for a number of years before I retired. We had nurses that made, good salaries, but no big deal. And their pension plans when they retired were in millions. It was crazy. What did they do? Nothing. They just worked. They had, a good investment plan, and they kept putting money in every month into the 401k plan, and it grew at this, 10%, doubles every 8 years, and they're working 30, 40-year careers, and they're millionaires. They're just making normal salaries. It's crazy. So I don't mess with any of the gimmick stuff. I don't deal with any of that. I have low-cost mutual funds with 10,000 or more companies in it, and all I did for 44 years was to put money in every month, and all I've done for the last 16 years is take 6% out every month, or 0.5%, 6% a year. And my history follows this 2008 thing. The numbers are different, but the ratios that's exactly me. And it's incredible. I mean, even on $1 million, you're taking out $1.1 million, you're ending up with $1 million after 15 years, and you're supporting an increasing lifestyle. I mean, so yeah, there's a whole lot of things. Brokerage accounts are different in that you may have a different investment mix, because when you get dividends in a brokerage account, you have to pay taxes. All of my money's been in the IRA 401k field, where it just grows tax-free. So that's the difference. So you would want to structure your CFP would want to structure a brokerage account a little bit differently, and it would still be highly diversified, but you might choose companies that don't pay a lot of dividends. So your income is not, your dividend income is great. You're concentrating on just the increase in value, which is not taxed until you take it out. And another thought about, just investing at an early age, the money you can get into a Roth account, whether it's a Roth part of your 401k or a Roth IRA, is a miracle on steroids. Because if you start early and get stuff into a Roth, you've already paid taxes on it. So it's more expensive in a way. But once you get money into a Roth, it grows tax-free. And then when you take it out, you don't pay taxes. All of my, well, not all the money I'm taking out comes out of a regular IRA, and I pay regular income taxes on it. If it were in a Roth IRA, zero taxes. That would be sweet. Save me 15 grand a year right now. So, but diversified, lots of companies. You invest it, you never take it out, let it grow, and that goes through your entire lifetime. And then when you get into the withdrawal period, like I did 16 years ago, very disciplined, withdraw a certain percentage every year that makes sense for you. But I'd stay in 100% stocks. One note about before I forget about investment advisors or CFP. I don't give investment advice. I just lay the numbers out to people and tell them what I do, because I don't want to get sued. I'm licensed, but I don't practice. The CFPs are very highly regulated, and they should be. I mean, we got Bernie Madoff and people like that in the industry. And they are very sensitive to a thing they call risk tolerance. So if they have a client who's really nervous about these ups and downs and is going to sell out when the market goes down, they can't, and they put them in a 100% stock portfolio, and the market crashes and people sue them. Or the regulators come in and say, well, you got them in a 100% stock portfolio, and you knew they were going to be volatile, and you knew they couldn't take the volatility, then you could be sanctioned and lose your license and lose your business. So they're very sensitive to this whole risk thing. That's why I spent some time talking about that. And that's true. I think if those same CFPs spend a little bit more time with their clients and educated them, and so that they got more comfortable with it, and they wouldn't panic and sell, then they could move them into higher and higher ratios of stocks. But I think a lot of the guys just bail out and say, well, I can't fight this battle. I don't want to get sued. So let's go 40-60, and nobody can complain that it's too volatile. So I hope that doesn't happen much, but there's a real fear of not being sensitive to someone's risk tolerance. And then this is mathematics, and emotions will trump mathematics every time. If I settle out after my 39% or my 18 and 22%, if I start selling these stocks during that period, then this all goes to heck in a handbasket. So that was a long-winded answer.
I got a question.
Yes.
So when you're in retirement, you basically have no more income coming in, correct?
Well, I have Social Security. I have a pension, but it's all fixed and it's not much. Most of my income comes from this. Now, there are many people my age that have large pensions that pay them a certain, my son is a retired police officer and he gets a monthly pension. It's a fixed amount and it's a significant amount. I have $948 a month from a pension. And that's it. All the rest of my income comes either from Social Security or from pulling money out of my investments.
Okay,
and that's really more typical.
So when you have, your nest egg that you're starting to pull from an income, and then you're going to have Social Security, or if you have a pension and those types of things. Right. So you take your lump sum and you roll it over into a mutual fund that is that's running even with the S&P. Is that kind of what you're saying?
That's the idea. And if you have money in the retirement accounts, IRAs, 401ks, and so forth, you can roll it all into your own IRA, and you don't pay taxes until you take the money out. If you can roll it into an IRA and then transfer it to a Roth IRA, you're going to pay tax on the money you transfer. But once you get into a Roth it will grow tax-free, and when you take it out, it will be tax-free. So Roth came along a little too late for me, and there was a minimum amount that I could put in. If I had the money I have in regular IRAs and a Roth IRA today, it would really be sweet. I would literally be saving 15 grand a year in taxes.
So what do you recommend if someone has a Roth and a traditional IRA and they retire tomorrow? Should they pull out of the Roth first because it's already been taxed, and then pull out of the traditional because your tax bracket will hopefully go down?
Right, and that's a very, very good question, and that's where a CFP comes in. I don't have those kind of tools, but they can put together the plan that goes out through the rest of your lifetime, and then you can play with those things and say, okay, what if this, what if that? And what you're asking involves some complexities with taxation. I've seen people literally take hundreds of thousands of dollars out of a regular IRA and put it into a Roth and pay the tax on it in that year. And I say, God, that's crazy. But what they were doing was that they were planning for the future and the next generation, and they were getting as much money as they could into the Roth IRA now, so that during their retirement years, that would build up just like it would in a regular IRA. But then when that money went to their heirs could take the money out tax-free. And if you look at a Roth IRA account, typically, if it's been on there very long, most of the money, the value is not what money was put in; it's the earnings, essentially. Right. And so that tax-free earnings is great. So yeah, in that case, it depends on, can you afford to pay the taxes? Number one, how much will that deplete the whole thing? And so it's a very complex equation. But CFPs will have the long-term planning models. They can put those data in there and say, okay, what if we do this? What's the impact? What if we do that? What's the impact? And very quickly, I can change these numbers up here. This is a very simple model. And, I put 5 in there and everything changes. Well, they can do the same thing. They can say, well, what if you take in, this kind of transfer? What does that mean for you long term and so forth? So very good question, but a very complex answer. And it takes models that I don't have.
Because the biggest thing for me in retirement will be taxes, trying to keep the tax man out of my pocket, right?
The more, again, the more you can get into the Roth arena, the better off you're going to be.
Yeah. Now, what about, what do you call it? When you have your gains, isn't there a tax on your gains that you have to pay?
When you sell. Yeah, capital gains.
Capital gains.
That's when you sell. Okay. That's when you sell. Right. Now, in this case, all of my money is sitting in retirement accounts. Mm-hmm. So when I take it out, it's just all taxed at regular income rates.
Okay.
Personally, if you have brokerage accounts, which aren't IRAs, 401ks, and so forth, then you will be taxed on dividends paid to you.
Yeah.
If you keep it in there. If you sell stock, then you've got a capital gains. But traditionally, capital gains rates have been much lower than regular income rates.
Oh, is that right?
So there again, you've got to balance how much are you making in dividends versus how much you're going to pay most people go ahead and sell, take the capital gains. It's going to be a lower rate anyway. That's who knows what's going to happen in the future, but that's typically been in the past.
Okay.
Good questions.
You know anything about backdoor Roths?
No.
Okay.
I'm not familiar with that term.
I think it has something to do with giving more like when you want to transition your traditional Roth into a traditional IRA into a Roth IRA.
Right. Well, there's a lot of misunderstanding there. If you have a Roth IRA that's open and has money in it,
okay,
and you have a regular IRA,
yeah,
there is a limit to how much you can add to an IRA, to a Roth in a given year.
Yep, right.
Your earnings. There is no limit. There is no limit to how much money you can transfer from an existing IRA to an existing Roth IRA.
Oh, okay. All right. So the limit
was, yeah, that trips up a lot of people. They say, well, it's only, $6,000 or $8,000 that I can add to my Roth IRA. And that is true. Out of your earnings, there's a limit to it. But if you want to transfer, you can take, I've seen hundreds of thousands of dollars transferred at one time.
Yeah, out of your traditional into your Roth.
Yeah, yeah. You don't pay tax on it.
Okay. Yeah, right.
But you can transfer it any amount.
Okay.
That's the current law, and there are lots of situations where that makes a lot of sense for the long term. The example I was giving you, they were trying to set up their estate so that it would maximize the return for their children. Okay.
Mm-hmm.
Well, they pay the tax now, get it into a Roth, and then from then on, the earnings, just like the regular IRA, would not be taxed.
Tax free.
Instead of their heirs having to pay tax when they took it out, zero tax has already been paid.
Okay.
So it's interesting. And every situation is different. Everyone is unique, and that's why you hire a CFP to look at your unique circumstances and say what's best for you, because there are general rules, but the questions you're asking are very specific questions to you.
Yeah.
If you would like to have this spreadsheet, give me your emails and I will email it to you.
Okay.
You can put them in chat.
Okay. I gotta find chat. Oh, I see it down
in
there.
the middle.
Oh, okay. Let's see. Oh, to your Eleanor.
Mm-hmm.
Okay.
Everything will go to me anyway. Okay, I got it. Here's another one.
Last thing I'll say is that if you have further questions, you think of something later, this last slide gives my email address, so feel free to email with me the questions or comments or whatever. I'd love to get your thoughts.
Are you here in Kansas City?
Yeah, I have an office in Overland Park. I live in Lenexa, so I'm available. And again, I am strictly a pro bono advisor, so most of the people I work with do not have a lot of money to invest. I have CFPs I refer people to, but I enjoy what I'm doing, and there's never any charge for meeting with me. So,
what do you think of those companies like Facet or companies that kind of give you advice versus using a planner?
Well, a financial planner is not just a one-time service. What you do with these people is they unpack everything about your financial life, get to know you, and it's an ongoing relationship. People who hire a financial planner, a good one, will stay with them, and they're fiercely loyal just because they just stay with you. They know everything about you, and you can put the whole thing in perspective. And you say, well, what should I do with my investments? What should I do here with this financial question? And it all depends on what your overall plan is. Does it make sense for you to do it? I mean, I'm going to eventually buy another car.
Yeah.
Well, when do I buy it? How much can I pay for it? Those kind of things, I want to make sure it fits into the financial plan. I say, okay, I want to buy it this year rather than 2 years from now. I'm going to go to them and say, does it make any difference? And they
Okay.
usually put in the model and say, well, nah, you go ahead, or you better wait. One of the big things is when do you retire? And lots of times you'll find, well, I'm going to retire at 65 or 66. Sometimes if you said, well, maybe if I worked 1 year longer, or 2 years longer, what difference does that make? And that one decision, that's very sensitive. I probably retired 3 years earlier than I really should have from a purely financial point of view. I just had some things I wanted to do, and so I don't regret it. But if you look at the financial situation, just pure numbers, I would be significantly better off financially today if I had worked another even 2 years.
I got you. Okay.
But I wasn't willing to do it, and I don't regret that I did, because I've enjoyed the retirement. But that's a very that decision of it's going to be this year, next year, the year after. That is often a very, very sensitive position, because you really, I mean, you're changing from making a lot of money to taking a lot of money out. You know?
Yep.
When that happens, it's a scary shift, that's for sure.
Yep.
Anyway, feel free to fire questions to me. That's I'll leave that up.
Okay, I appreciate it.
You betcha. Well, Aline, I think we're probably done here. Thank you.
Looks like it. Well, thank you very much, everybody. It's been very interesting and informational. So thank you very much. And I hope that we will continue working together for the benefit of our customers. Thank you very much, and have a great day.
Great.
Awesome. Thank you.